Laurie, your year end next year, 50-50. Walk us through it.
Sure. Look, it's all about the numbers for us, John. And before I get into that, let me just tell you, I sympathize with where your head is at. We called our weekly this morning goodbye to 2021. We're ready for it to be gone. But look, I think it's first off the strong economy. Most of our economic modeling is pointing us to an S&P 500 north of 5,100. Then it's looking at stocks versus bonds. At least for another year, I think stocks are still the best game in town. So our models there are pointing us to about an 8% type return. I think where things get interesting is what happens with PE multiples. If you assume a flattish PE, we should be, around my target. If you assume some contraction based on a more aggressive Fed, and that's a realistic risk in here, that does point you to about down 2% on the year on our models. So that would be our worst case scenario. It's a real risk to monitor, but the preponderance of the evidence on the economy, and again, stocks versus bonds, is telling us to look for another good year in stocks. Not as good as what we had this year, though frankly, it felt lousy to get to this return that we've gotten. But I think we'll have another good year next year, but it's going to be a bit harder.
It's going to be a bit harder, and you outline how in the first half of the year, you might get an outperformance of the value trades of some of the cyclicals, and in the back end, it's going to be a rotation back into growth. Can you give us a sense of what that means in terms of the ongoing bearishness in terms of economic growth that you see to the second half of the year?
So look, it's not, and I'm sure my economist is kind of shuddering if he's hearing this right now, but what we're seeing in 2023 is that if you look where the street economists are forecasting, they're right at around 2.5%. Now, that's not a recession by any stretch, but it is a deceleration back to trend-like growth. And what we do tend to see is that when markets, and markets, again, are very forward-looking, when we're in a hot economy like we're supposed to be in next year, 4% is basically the number in place for next year by most economists, value small-cap cyclicals tend to outperform. But when you move back down to trend-like growth or below trend-like growth, that's when those more defensive parts of the market, like large-cap, secular growers, and the growth trade itself, tend to outperform. And we think at some point in the middle of next year, we're going to see markets start to focus on 2023 and be done with 2022. And once that happens, we'll probably be well into Fed rate hikes. And that also tends to be a trigger to get you away from those cyclical trades and back towards the growth trades.